Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. Great to see everyone. I can see a lot of questions already streaming in. Awesome. All right, so just a couple things before we get into your questions. Quick pit stop over here at the Forex Factory calendar and scrolling down to Wednesday, Feb 2-3. Pretty quiet day. I like days like this because we don't have any economic data releases, aka you'll notice no red hot zones with the U.S. market. But the reason I'm bringing it up is that, remember, the markets are going to look ahead as well. Tomorrow's session, an hour before the bell rings, we've got one of the two hot zones that I listed on the weekly sector and macro notes that those of you that are in the futures room, the options room, the sector secrets mastery room, I did share those across the board this week, and you'll see the hot zone that I shared were the tomorrow's GDP and Friday's PCE. If you are, and hopefully you have been, looking at the clarity for the March meeting, that 25 to 50 column has been all over the place. We've been above 80. We've been below 80. We see that 50 to 75 column, which would suggest a half point rate hikes to creep up again. In fact, we were down below 20% over the weekend going into Tuesday's trading session. Now, boom, you can see that quarter point hike. We're still getting at least that. But then the question is, do we get the half point? Tomorrow's GDP and tomorrow's GDP and Friday's PCE could be a big part of what we are dealing with. So keep that in mind. And in terms of, again, really easy principle of macroeconomic study. This is not complicated. This is not even a discussion that needs to be had every day. In fact, it's actually counterproductive to do that. Macro moves according to particular data releases, inflation, GDP, any of the FOMC members speaking, especially if they're voting members, anything that relates to money supply, monetary policy. And jobs. That's that second mandate for the U.S. central bank. Pay attention to those specific days, in this case, 8:30 a.m. Eastern releases. Those are going to be when the needle moves for understanding the macro, and this will no doubt be affected. So as always, great to see everybody here. Let's go ahead and jump into your questions and kicking it off with Christian, who asked two questions. Okay. Regarding the 34 EMA, what makes this the most attractive entry compared to others like the 21 or 50? Christian, I tested it. I find that the market can go to the 34 quite a bit. Please know that anytime I bring an indicator to you all, this is anytime. And this is something that's really important to me. It's not because I've been using it for 2 months or 6 months. It's not because it's something new that I think could be cool. It's because I have been using it for years. In the case of the 34 EMA wave and the grab candles related to that, this has been almost 3 decades. 21 exponentials are great. They're oftentimes too aggressive. Not always. That's why we have propulsion dots. But for the most part, if we talk a reversion to the mean, and I've got crude oil up here, that reversion to the mean for me happened on February 18. We sunk into the wave. And the wave is a zone, right? 34 EMA high to low zone. So testing, that's why. Also, for my long calls, long puts, do I buy at the money? Yes, at or slightly in the money. And then the last bit of your question, Christian, I'm going to sound like a heretic, but I'm telling you right now, I have never nor will I really ever give a rip about Greeks. I know that makes me sound insane. I've been trading options productively, successfully, profitably, right? All three matter for many decades, never really caring what the delta or the theta or the any of those Greeks mean. Because if I am, but I can tell you anecdotally that I'm usually about a 50, usually 50 or a little bit better, 50 or a little bit better. So at the money, what matters more is the momentum and the trend that you're buying your options within. And by the way, selling your options within as well. So no, I don't look at Greeks at all. I talk about time decay. Sometimes I'll say theta. I should probably take that out of my vocabulary because I don't give a rip about theta. I do know, however, I know, see, salty Raghee first thing in the morning. I love the question, Christian. Time decay. We know that if momentum's not moving in our favor, which is the one thing that can offset the natural time decay of an option, which is a depreciating asset, right? It's like a car. You roll it off the parking lot of that car dealership, it's already losing value. That's what an option is like. When does it really start to lose value? Usually within inside 21 days. You can see that the time decay really starts to get exponential. So at the money, or slightly in, and give yourself some time. That's really important. Give yourself some time. So thanks for the question, Christian. Next up is TSN. Love TSN, Furman. This is one I talked about in the mastery, and I believe in the free video. So if you haven't checked out the free video, back over at the Simpler Trading YouTube channel, you'll see there futures tradings, which trends are correcting now. I talk about bonds. I talk about oil. I talk about oil stocks. What else we talk about? Treasuries. Oh, grains. We've been talking about grains for the better part of a couple months now. Corn, beans specifically. And then the agribusiness trade that is very much part of the inflation trend that we're seeing. So check that out. And TSN, and as well as ADM, Furman were two of those stocks to keep an eye on. So TSN, yes, we have an ex-dividend date coming up, which can mean we might see some weakness after that date. I don't like it as much as, say, a pullback in ADM, but I will be keeping an eye on it. I am looking at TSN. The only thing that we need to make sure is the liquidity at the strike that we are looking for. Okay. Next up, Martinko asks, what option expiration do I typically choose for swings? So great question. Let's unpack that. So swings are almost always going to be a daily time frame. Let me mention something here, gang. There are many time frames we can choose from. A little bit of advice that helped me, all right? We're choosing symbols. We're looking for outperformers. And then if you're looking across multiple time frames, you're going to get frustrated, because if one time you see a trade going off in a 30, and the next time it's going off on a 1 hour, and the next time it's going off on a 2 hour, and the next time it's going off on a 4, now you're not only building a watch list of symbols, you're really building a watch list of time frames. I find that to be really unrealistic to always choose the right time frame, right? So if I'm not day trading on a 2 or 5 minute time frame, I'm on a daily. And so swing really is, in the most basic way, a daily time frame entry. I'm going to have overnight exposure, probably for days, possibly for weeks. You know? So now we got swing is. And the word swing is not about hold time. It's not about time horizon or whatever the common definition is, 3 to 5 days. That's not how I look at a swing. The word swing in swing trade, for me, the swing is synonymous with a correction. The swing is actually synonymous with the market move, not this time horizon, which is sadly, weirdly, very still popular in terms of defining what a swing trade is. So that's number one. Number two, as far as expiry, I like to focus on about 45 days minimum. And you bring up some really cool questions. And I think this is a great time to remind everybody, if you have not penciled it in yet, get your calendar out. Maybe you use your phone as a calendar. I know I do. March 9, I think it's going to be 8 p.m. Eastern. Jot that down. Keep that evening free because we are going to dive into the free tools that I share with you over at countdowntrader.com, as well as some of these questions here as far as, Raghee, you buying at the money, out of the money? Why the 34? What the wave and the grab are measuring? Why did you settle on that? What makes it so powerful? And, I was looking at the trades that we've been doing in the mastery since the end of January. And the same process that I'm explaining to you, Christian and Martinko and everybody here in the room. Martinko, oh my gosh, I'm completely messing your name. Martinko. That's very cool. And then the last name, you got to phonetically break that down for me because that looks so neat. That could be a clothing brand, that last name. That is so cool. And yes, Trish confirmed 8 p.m. So I was looking at my trades in the beginning of January. The first week of January, I got rocked. I looked at trends that were working through October, November, December. We all start to slow down some of our activity between Thanksgiving and Christmas. That's normal. So we don't really always feel significant changes in market behavior towards the end of a year because, we're starting to check out, right? But in the beginning of January, and I'll talk more about this on March 9, I got rocked. I went, I think, 3 or 4 losses in a row. And I thought, wait a minute, stop, right? Take inventory. What's going on? You don't hit the gas pedal and start betting bigger. You stop. So we paused for a good 10 days. If you're in the mastery, you knew for at 10 days, we were talking about the environment. We were building watch lists. We were not trading. The very end of January, all of a sudden, things lined up. We had a better understanding of technical and macro trends, and we've hit the gas pedal ever since. And I want to show you all something because I'm going to dive into this on March. I'm going to dive into this a little bit in the live session. These are all the trades that we've done since the end of January, and it's only February 23. All of a sudden, everything started lining up, and then we got much more active. Why was that? Because when we give ourselves time, to your question there, my friend, I'm able to start thinking beyond the twitchiness of Russia, Ukraine, or the twitchiness of whatever, some FOMC member. Remember when Ballard was sort of rocking the markets? He did that twice. Those were opportunities. We started using that noise, that volatility for our trend following approaches. And I was joking with Lorna just last night. I was kind of joking, and this is what I do when I'm, where is it? There we go. The trend is out there. Everyone keeps talking about these markets are so tough. Where is the trend? They are out there, gang. I know everyone thinks right now a trend is an X-file. It's not. They are out there. So thanks for the question. All right, let's take a look at F. Here's one of the trades that have not stopped us out yet, but they're not going in our favor yet either. And this is where kind of going earlier to the question about expiration matters. I'm still in F. I know that we're dealing with a downtrend because we've got the red momentum, red trend, right? Or as we call it, double red. Plenty of red grab candles, but we're still above the 200. Very inexpensive option, still within the paper cut threshold of our risk management. I'm not, quote unquote, adding to this trade. We've moved on to a lot of other great winners, but I still have this trade open. So stop losses, Hamza, what did you pay? And what is your paper cut risk that does not exceed 5% of your account? You can even be topped out at 3. All right. So that risk and account threshold management is key to position sizing for sure. And it then relates to not just how many contracts we buy, but what our stop loss is for those contracts. And right now I'm not stopped out of forward yet. We'll see, maybe soon, but not yet. All right. And I'm taking heat on this, no doubt. No doubt. I've got the similar situation going on in KMI, right? I got a lot of noise here. However, I think what happens to a lot of traders, and this is such a great question, what happens is a particular stock starts giving them, or ETF or futures contract starts to give them issues. And they keep piling into this. Gang, I think most of our mastery folks are out of that tiny little paper cut in KMI. We've moved on to XLE. We've already had some winners in crude. We've moved on to other corners of the market. And I think this is something that we all need to learn to do. If there's a particular market that's giving us fits, or if we just got stopped out, do yourself a favor. Try this for a month. Do not go back into that particular stock, into that particular symbol. Maybe look at something related, but you can't go back into that one. And you're going to find that trade that you might like that might be related is going to be a far better setup. We did that earlier this year. I said January was pretty tricky. I got stopped at a DHI on a 200. It ended up bouncing off the 200, but it lost traction in the wave. So rather than going back in and putting on a revenge trade, I said, hey, there's a reason I liked DHI, but it stopped me out. Where is there a fresh entry? So the next time we went in, we actually bought that level right there and played Pulte instead. Don't go back into the same symbol. Try another one. You're going to find it almost becomes sort of a blank page again. It's you just get to turn the page on the loss, and you start off with fresh eyes and a fresh mind. So give that a whirl. Think about that. And F, I think, and KMI are really great examples. We've gone into related trades, Hamza, to F, and related trades to KMI, but not F and not KMI. So I hope that resonates. Give that a whirl. All right, William, good morning. With the DXY drop this week, global currencies have all been up, both in Asia and Europe. Any thoughts on Forex these days? I still have a bullish bias on the dollar, and I still have a short euro position via the 6E off the 115 handle. So William, the extent of my exposure right now is I want to get my US dollar buys back on the book, maybe via UUP, but right now my favorite way to do it is fading the 115 handle on the 6E. You can play the same thing on the euro US, okay? Next up, Peter, thanks to your videos. I've learned a lot. My pleasure, and truly my job, right? I mean, I think that, why else would I be doing this other than hopefully to create this community of traders that are using similar tools, using a similar mindset, and then we become a think tank. It's very self-serving. I want to create a group of traders who are doing things in a similar way so we can support each other, right? And so if we're able to do that, now we've got many, many eyes looking at the market, working together, supporting each other, and we become formidable, right? So I do appreciate that, Peter. My morning charts and coffee. Oh gosh, my pleasure, Peter. Peter, you're gonna love March 9. So definitely, I look forward to seeing you there. John, can we check out the pullback in XLE? Jalen, yes, sorry. I have my font way too small. I apologize. I can't see. Yeah, these glasses that I've been wearing since the 4th grade, every now and then it totally reminds me, Rog, your vision's pretty bad. Jalen, thank you for the question on XLE. Yes, we're long XLE. Yesterday, I sent out just a heads up to the members. We've had out there since the 15th an alert from an aggro level. Now, it's a very small amount of capital spend. It's only 25% of our budget. And if you don't know what budget is, you're definitely going to want to be there on the 9th. So we spend about 25% of our budget. So we're long XLE from an aggro level. So that pullback in XLE was 2 times, actually 2+ times the daily price movement range, which is a historical volatility measuring stick. And so I usually like to see an inside candle. That would be ideal, or a minor low. That would be ideal. But the aggro got hit. And if I put an alert out there, again, we sent this out on the 15th. This triggered on the 22nd. I'm not going to take it back and say, no, don't trigger. Hey, I sent it out for a reason because that would be valid as far as I'm concerned. So we do have the aggro. And not that I was doubling down, but I loved that move. We got into Halliburton, HAL. Right here. There we go. We got into HAL for a similar reason. It was a big move, granted, but we had an opportunity at the 21. We deploy a small amount of capital, which reduces our risk, reduces our spend. So yeah, I'm a big fan of that pullback in XLE, OIH, HAL. Yeah. So if we start moving up from there today, well, let's follow through. If we move a little bit lower, Now we're going to head down towards those moderate and conservative zones. All right, so Cisco, I do have exposure to Cisco. Again, I always like to let you know when I do have exposure to a name. We're short Cisco. I will tell you this, though. We got short as we had this crazy candle here on the 17th. The 18th pretty much did the same thing. Look, if we had a crazy candle on the 17th and we saw pretty much the same width, scope, move on the 18th, it wasn't as big a deal. It wasn't fun. Mind you, we took some heat, but not enough to stop us out. And we knew that there's likely going to be some lingering volatility post earnings. And then now it looks like things are coming back down in our direction. So yes, we've already built that short in Cisco, but really important to realize our mastery members are not just mastery. Look, we master momentum as options traders. It's important that we do. The move higher on the 17th and even the move higher on the 18th allowed us to build positions via puts on days where I believe there's a momentary mispricing in the option. It's as basic as this. If traders are looking at the market moving higher, do you think puts are more expensive or less? Right? What was more expensive? Calls. What is there more demand for? The calls. So on the way back down, those calls are going to become more expensive. That momentum, mastering that momentum is really, really important. Okay. All right, gang. So thank you as always. Thank you as always for joining us for Charts and Coffee. Time for me to head on over into the mastery room for our weekly live trading Q&A. We're going to review the open trades. Again, we've been very busy since the end of January. It's been a really good February. Why? Because the trends, both macroeconomically and technically, are clarifying. What was difficult, say the end of December or even the beginning, say first 2 to 3 weeks of January, have clarified. If you're still struggling now in February, definitely join me for March 9, because what we're going to do is talk about, hey, I was struggling too. What were the shifts we made and what were the indicators we used to make that shift? Punchline, you don't have to buy an indicator. Go grab them from Countdown Trader before March 9. Get used to them visually on your charts, and we'll talk more about them then. All right, be good to each other. I'll see you tomorrow, same time, same station.